The barrier everyone said couldn't break just did. For months we heard the same story from every corner of finance. $65 was the line. That was the ceiling. That was where the market would turn back every single time. But on Wednesday, December 17th, something shifted. We didn't just touch that level. We went straight through it. Earlier in the session, the spot price of silver climbed all the way to $66.50. Right now, as we're looking at this, we're sitting around $65.80. Now I understand what's going through your mind right now. You're watching that pullback from the high of $66.50 down to where we are now, and you're wondering if that was the peak. You're asking yourself whether this is just another false signal. But what's unfolding right now isn't a reversal. It's not a failure of the move. What we're seeing is actually one of the most important technical patterns a market can show. This is what traders call a retest. In this breakdown, we're going to walk through exactly what happened with this move above 65. We're going to explain the mechanics behind that rapid spike to $66.50. We're going to look at the options related buying pressure that forced certain participants to purchase contracts they weren't planning to buy. And most importantly, we're going to show you why this pullback to $65.80 is actually constructive for what comes next. If the price had continued straight up without pausing, we'd likely be looking at a much sharper correction right now. By pulling back and finding support at prior resistance, we're establishing a foundation for the next phase. The level at 65 has been breached. Now the market has to prove it can hold above it. This is the anatomy of the breakout. To understand why silver moved from 64 to $66.50 so quickly this morning, you need to understand how market maker hedging works. This involves something called gamma exposure. Gamma measures how quickly a dealer's risk profile changes as the underlying asset moves. Think of the market maker as the entity that sold call options at the 65 strike price. These are contracts that gain value when silver rises. As long as silver stayed below 65, those contracts were out of the money, and the market maker's exposure was relatively stable. But the moment silver crossed above 65, the risk profile for those dealers changed dramatically. When the price hit 65.10, the risk management systems at these firms signaled that adjustments were needed. To hedge that exposure, the systems automatically purchased silver futures contracts. They weren't buying because they had a bullish view. They were buying to neutralize their risk. But here's where the feedback loop starts. That buying pushed the price higher to around $65.30, which increased their exposure even more. So the systems bought additional contracts, which pushed the price towards 66. This is the gamma-related buying pressure. It's a self-reinforcing cycle driven entirely by risk management algorithms. It's the same dynamic that drove certain equity moves in early 2021. This isn't about supply and demand fundamentals in the traditional sense. This is about mathematical hedging requirements. This morning, that math created intense upward pressure. The move to $66.50 was driven by automated systems covering exposure. It was a low liquidity environment with very few sellers and a concentration of buy orders. So why did it stop? Why are we back at $65.80? Because discretionary traders stepped in. When participants saw that vertical price move, many took profits. The gamma-related buying reached its natural limit, and now we're back to a more normal trading environment. But the key point is this: the 65 level has been broken. The psychological resistance has been tested, and the market is now aware that the structure has changed. The dealers know the dynamic has shifted. Let's talk about where we are right now. $65.80. To someone unfamiliar with technical analysis, a drop from $66.50 looks like weakness. To someone who understands market structure, it looks like confirmation. There's a principle in technical work that former resistance tends to become new support. For months, 65 was the ceiling. Every time the market approached it, we saw selling pressure. It acted as a barrier. Today, we moved above that barrier. Now we're testing it from the other side. We're checking whether it can hold as a floor. This pullback to $65.80 is the market's way of validating the breakout. We need to see buyers willing to step in at this level. We need to see the price stabilize above 65. If we close the day above 65, it suggests that the breakout has credibility. It tells the market that 65 is no longer the level where selling dominates. It becomes the level where buying interest emerges. However, there is a consideration here. If the price drops back below 65 and we close the session at 64, that would be classified as a failed breakout. It would indicate that sellers are still in control at these levels, and typically a failed breakout leads to a sharp move lower. So $65.80 is a critical zone right now. We're in the buffer above the prior resistance. We haven't confirmed the breakout yet. We need to see how the daily session closes. We need to see whether this former resistance can genuinely support the market at these higher levels. Remember the large buyer we discussed previously, the participant who absorbed hundreds of millions of dollars worth of silver around 63. People have been asking whether they exited at $66.50. Whether they sold into that spike. Based on order flow data from this morning, the answer appears to be no. When the price pulled back from $66.50 to $65.80, we saw large block orders appear on the bid side. Someone stepped in around $65.75 and provided support. This tells us something important. The institutional capital that was buying in the low 60s believes 65 is still attractive. Last week they were comfortable accumulating at 63. Now they're willing to support the market at 65. This isn't the behavior of a participant looking to exit quickly. Speculators typically sell into strength. This buyer is supporting on weakness. They're placing a floor under the market to prevent it from collapsing back below 65. Why would they do that? Because they understand what happens if 65 holds. They understand that if this level is confirmed to support, the next meaningful resistance isn't at 66. The path becomes much clearer toward 70 and potentially 85. They're establishing a position. They're securing their allocation before the next leg higher. So when you look at 6580, don't interpret it as a loss. Interpret it as consolidation. View it as larger participants repositioning and adding to positions. The gamma-related buying was the catalyst. The retest is the fuel. But the real accelerant comes from short covering. The commercial entities that have been short silver for years are now facing significant unrealized losses. In the next section, we're going to examine what happens when those short positions start to close. We're going to look at reports suggesting a major commercial participant may have begun covering their position this morning. We're going to explain why short covering acts as one of the strongest bullish forces in any market. And we're going to calculate the approximate losses these entities are sitting on after the move to 650. The breakout has occurred. Now the covering pressure begins. If you're just tuning in, here's where we stand. We've confirmed that silver broke above the 65 level. It touched 6650 and is now consolidating near 6580. The gamma-related algorithmic buying was the spark, but a spark doesn't sustain a rally. For a move to continue, you need fuel, and in the silver market the fuel isn't retail buying. It isn't even industrial demand in the immediate term. The fuel is short covering by commercial participants. For decades, the large banks have operated a very profitable strategy. They sell paper contracts when prices are elevated. They buy them back when prices are lower. They act as a stabilizing force in the market. They maintain equilibrium around certain levels. But today, when the price crossed 65, the mathematics of their positions changed. What was profitable became problematic. We're hearing reports that are unconfirmed but circulating widely that a major commercial participant began closing short positions this morning. In this section, we're going to break down what that means. We're going to estimate the losses these entities are facing based on current price levels. We're going to explain why a short position being covered creates buying pressure. And we're going to look at why this particular price zone is significant for margin requirements and risk management. These institutions aren't fighting the market anymore. They're managing their own exposure. Let's look at the data. To understand what's happening in New York right now, you need to look at the Commitment of Traders report. This is a weekly disclosure that shows positioning by different participant categories. The commercials, which generally refers to banks and large institutions, have historically maintained net short positions. This means they've sold more contracts than they've bought. According to the most recent data, their net short position is approximately 80,000 contracts. Each contract represents 5,000 ounces. Multiply those numbers. 80,000 times 5,000 equals 400 million ounces. That's 400 million ounces of silver they've committed to deliver, but don't physically hold. They sold these contracts at lower prices, hoping to buy them back cheaper. But many of those sales occurred when silver was at $50. Some occurred at $55. Today the price is $65.80. Every one of those contracts is showing an unrealized loss. This is what traders call being caught in a position. When you're long an asset, the maximum loss is limited to the amount you invested. When you're short an asset, the potential loss is theoretically unlimited. If silver reaches $100 or higher, these entities owe the difference. There's no cap on the liability. So at 650, the risk departments at these institutions had to reassess. They looked at the exposure, they looked at the collateral requirements, and they recognized they're holding positions that could offset their earnings for the quarter. This forces a behavioral shift. Typically, when silver rises, these participants would add to short positions to stabilize the price. But today, their risk limits are constrained. Instead of adding shorts, they have to reduce them. And how do you reduce a short position? You buy. You become a buyer. You compete with industrial users. You compete with the large accumulator we discussed. You compete with retail participants. Price becomes less relevant than risk management. You need to close the exposure. This creates persistent buying pressure underneath the market. It creates a support mechanism. Every time the price dips, someone steps in to cover a portion of their position. This is why 65.80 is holding. The short sellers are unwinding their own positions. Let's quantify what this means in dollar terms. Markets respond to losses, and right now the losses are concentrated among a small number of large institutions. For every $1 increase in the price of silver, the aggregate commercial short position loses approximately $400 million. Since the breakout began around $60, silver has risen nearly $6. 6 times 400 million equals $2.4 billion. That's $2.4 billion in unrealized losses across the commercial short book. In accounting terms, that's significant, but it gets more complex. That calculation assumes they can cover their positions at the current market price. But they can't. If they attempted to buy back 400 million ounces right now, the price wouldn't remain at 65. It would spike immediately. This is called slippage. The act of exiting increases the cost of the exit. So the actual loss isn't 2 billion. It could be 5 billion or 10 billion depending on how quickly they try to close. It's a liability that grows as they attempt to manage it. This is why 65 was such a critical level. Above this threshold, the losses become material enough to trigger internal reviews. Above this level, senior management gets involved. Regulators start asking questions about capital adequacy. We're watching this unfold in real time. These institutions are trying to exit their positions gradually without causing the price to spike further. But the large buyer we've been tracking isn't allowing them to exit easily. That buyer is absorbing available supply, so the short sellers are forced to pay higher prices. This is the core dynamic of a short squeeze. It's not just about price appreciation. It's about the transfer of capital from entities that were short to entities that are long. Every dollar the price increases represents $400 million moving from institutional balance sheets to the accounts of those who position correctly. How do we know this covering is actually happening? How do we know these institutions aren't simply adding to their positions and preparing for another move lower? We look at open interest. Open interest is the total number of outstanding contracts in the futures market. In a typical rally, both price and open interest increase together. But in a short squeeze, price rises while open interest declines. Why? Because the short sellers are closing their contracts and leaving the market. They're reducing their exposure. Later today, when the exchange releases preliminary data for Wednesday, we need to monitor that number closely. If we see price at 60, 580 and open interest has dropped significantly, that's confirmation. It tells us the rally was driven by short covering rather than new speculative buying. This is one of the most constructive signals a market can give. It means the entities that were providing selling pressure are exiting. Once the short positions are closed, who remains as a seller? Very few participants. The selling pressure diminishes and the price can move more freely toward fair value based on physical supply and demand. However, we need to be realistic about one thing. Large institutions don't go quietly. Before they fully capitulate, they may attempt one final aggressive move. They might sell a large block of contracts during low liquidity hours to create the appearance of a breakdown. They're testing whether they can trigger panic selling. If we see a sudden drop to 60, overnight, we shouldn't assume the trend has reversed. We should interpret it as the final attempt by short sellers to create enough liquidity to exit their positions. Unless we break below 60-150, the uptrend remains intact. Short covering is a process that unfolds over days or weeks. It's not a single event. So these institutions are managing significant paper losses. They're attempting to cover positions. But while the futures market operates on leverage and digital contracts, the physical world is operating under different constraints. The reason the price spiked to 60-650 wasn't only about gamma or short covering. It was driven by something more fundamental: scarcity. In the next section, we're moving away from Wall Street and looking at the physical market. We're going to examine reports that major industrial users are currently paying $70 per ounce to secure actual metal. And we're going to look at the retail dealer market, where premiums are rising even though the spot price has stabilized. The paper market is experiencing stress. The physical market is experiencing a structural shortage. If you're only watching the price on financial news networks, you're missing a significant part of the story. You see 60, 580. You see the fluctuations on the chart, and you assume that number represents the cost of acquiring silver. It doesn't. It represents the price of a contract for future delivery at a specific location under specific terms. But if you step away from the screen and enter the physical market, the pricing structure is completely different. If you contact a refiner or attempt to purchase significant quantities of physical product, you're entering a separate market with separate pricing. In this section, we're going to examine the disconnect between the spot price on the exchange and the actual transaction prices in the physical market. While the paper price is holding near 60, 6 major industrial consumers are reportedly paying $70 or more to secure delivery. This is what's known as the premium market. It's the price that manufacturers pay to keep production running. It's the price that government mints pay to source blanks. And it's the price that ultimately determines long-term equilibrium. The paper market reflects expectations. The physical market reflects reality, and right now reality is moving faster than expectations. Why would a corporation pay $70 when the quoted price is $65.80? Because of operational necessity. Imagine you operate a solar panel manufacturing facility. Your production line costs $1 million per hour to operate. If you run out of silver paste, the line stops. You lose millions per day. You contact your supplier. They tell you they can source material at the exchange price, but delivery will take 3 weeks. Or they can provide material from their reserve inventory immediately for $70. What decision do you make? You pay the $70. You pay the premium because the cost of the metal is negligible compared to the cost of halted production. We're seeing reports that this premium buying is accelerating across multiple industries. Electronics manufacturers are bypassing exchanges entirely. They're going directly to mining companies and refiners offering expedited payment terms and premium pricing to secure priority delivery. This creates what's called a two-tier market. Volume is moving off exchange. It doesn't appear in the reported statistics. It doesn't immediately affect the spot price, but it reduces the available physical inventory while the paper market continues trading contracts back and forth and managing technical levels. The actual metal is being allocated to end users at significantly higher prices. Eventually, this gap closes. When the exchange runs low on deliverable inventory, the spot price must adjust upward to reflect physical scarcity. That's when you see silver jump several dollars in a single session. We're currently in that transition period. The screen price lags the transaction price. Now let's examine the retail market where individual buyers participate. Go to any major online precious metals dealer right now. Look at the premiums above spot price. Typically, when spot price rises, rapidly premiums contract. Dealers want to move existing inventory. But today, both spot and premiums are elevated. Why? Because dealers are concerned about their ability to restock. They sold you a coin yesterday at 63. Today, to replace that inventory, they might need to pay 65 or higher. They're experiencing margin compression, so they widen the spread. They charge you 65 plus an $8 or $10 premium. The total cost becomes $75. They're effectively rationing supply by pricing, or they shift to delayed delivery models. Ships in 4 to 6 weeks. Do you understand what that means? It means they don't have the inventory on hand. They're accepting your payment today, hoping to source the metal over the coming weeks. You're providing them with an interest-free loan. This is a risky position. If the price moves to $80 in 2 weeks, the dealer may not fulfill the order. They may refund your original payment and explain they couldn't source the product. You get your depreciating currency back, but you missed the price appreciation. This inventory constraint at the retail level is a leading indicator. When dealers stop offering immediate delivery, it means their wholesalers are constrained. And when wholesalers are constrained, it means refiners are constrained. The supply chain is tightening. So if you see 65.80 on the screen, don't assume you can acquire physical silver at that price. The real entry price for retail buyers is currently $75 to $80. The discount window is effectively closed. This brings us to a critical risk scenario called force majeure. We've discussed industrial buyers paying 70. We've discussed dealers charging 80. But what about the holders of paper claims? The people who own exchange-traded products or unallocated accounts? They hold contracts that state they're owed silver, but almost every one of those contracts contains a clause. It states that if delivery cannot be fulfilled due to market disruption, the issuer reserves the right to settle in cash equivalent. We're approaching the conditions where that clause could be triggered. If the physical price is 70 but the paper price is 65, it becomes economically rational for the issuer to pay you 65 in cash rather than go into the market and purchase $70 metal to deliver to you. It's cheaper to default in cash terms. If we see a wave of cash settlements begin, it undermines confidence in the paper system. It destroys the premise that paper claims are equivalent to physical ownership. Investors who receive cash settlements will likely take that currency and attempt to purchase physical metal, driving premiums even higher. This creates a reinforcing cycle. Shortage leads to premiums. Premiums lead to cash settlement. Cash settlement leads to loss of confidence. Loss of confidence leads to physical buying. Physical buying leads to higher premiums. We're in the early stages of this dynamic right now. The 65 breakout was the signal. The inability to source metal at that quoted price is the confirmation. If you hold paper exposure, you're relying on the system to honor delivery commitments. If you hold physical metal, you've already removed that counterparty risk. Looking at the spread between paper and physical today, the system is under stress. So we've covered the technical breakout. We've examined the institutional losses. We've exposed the physical market disconnect. The data supports the bullish case. The geology supports it. The industrial demand supports it. But there's one variable that can override all of that: your own psychology. The next several days will test your conviction. Volatility will likely increase. Headlines will become more dramatic. Institutions will attempt to shake out weak positioning before prices move significantly higher. In this final section, I'm going to provide you with the framework to manage that volatility. I'm going to show you the price levels that matter for the rest of this week, and I'm going to give you a strategy to ensure you don't exit a profitable position prematurely. The barrier has fallen. The path forward is clear. Don't stumble at the critical moment. We've reached the final part of this analysis. We've broken down the mechanics of the breakout. We've calculated the billions in institutional losses. We've revealed the $70 physical price that industrial users are paying right now. But now we need to step back. It's easy to get consumed by minute-to-minute price action. It's easy to stare at 65.80 and worry about whether it will hold for the next hour. But if you do that, you lose sight of the broader picture. Today, Wednesday, December 17th, 2025, represents a significant inflection point. The era of artificially suppressed silver prices is ending. The era of tightly managed price ranges is ending. We've entered a phase of genuine price discovery. This is both uncomfortable and exciting. In price discovery, there are no reliable historical resistance levels because we're trading at prices that haven't been sustained in decades. The market is attempting to find equilibrium between physical scarcity and monetary expansion. And I can tell you with confidence the equilibrium price is not 65. It's not 70. It's multiples higher than where we are now. In this final breakdown, I'm going to give you the mental tools to navigate the next phase. I'm going to show you why 65 is actually undervalued when adjusted for purchasing power. And I'm going to provide you with a framework to ensure you don't exit your position just as the real move begins. The barrier has fallen. The road ahead is open. Let's conclude. The biggest risk you face right now isn't from institutional selling, it's from psychological discomfort. When an asset moves this rapidly, when it breaks through long-term resistance and enters uncharted territory, human beings experience cognitive dissonance. You look at your account. You see gains that normally take years to accumulate happening in days. And your brain tells you this can't last. It must reverse. Take profits and lock in the gain. The institutions understand this. They rely on it. They know that most individual investors lack the conviction to hold through volatility, not because they lack capital, but because they lack a framework. So in the coming sessions, expect volatility to increase. We may see silver drop $3 in an hour. We may see it rally $5 the next hour. This is designed to create emotional exhaustion. They want you to become so uncomfortable with the swings that you exit just to regain peace of mind. Don't give them that outcome. Volatility is the cost of participating in wealth transfer events. If you sell now at 60, 580, where are you going? Back to currency that loses purchasing power at 5% annually. Back to equity markets that are trading at historically elevated valuations. You need to understand that silver isn't just appreciating. The dollar is depreciating. Silver is simply reflecting the ongoing debasement of fiat currency. Don't sell the lifeboat to buy a ticket back onto a sinking ship. Turn off the intraday charts. Stop watching the 1-minute candles. Look at the weekly chart. Look at the monthly chart. The trend is unmistakable. The momentum is building. Let the market work for you. But 65 is expensive. I hear this frequently. People think because silver was $20 a few years ago that 65 must represent a bubble. Let's examine the data. In 1980, the Hunt brothers drove silver to $50 per ounce. That was the all-time nominal high, but $1 in 1980 had significantly more purchasing power than $1 in 2025. If you adjust that $50 high for official consumer price index inflation, that $50 is equivalent to roughly $170 in today's currency. Think about that. To simply match the inflation-adjusted high from 1980, silver would need to nearly triple from current levels. At 65, silver is trading at a 60% discount to its inflation-adjusted historical peak. It's one of the few major asset classes trading this far below its real historical high. Equities are at nominal all-time highs. Real estate is at nominal all-time highs. Collectibles are at nominal all-time highs. Silver is still recovering from a 4-decade consolidation. So when you feel like 65 is elevated, remember that you're buying an asset that is historically undervalued in real terms. We're not at a top. We're barely off the bottom. This perspective is your defense mechanism. When media outlets call this a bubble, you look at the inflation math and remain calm. The bubble isn't silver. The bubble is in fiat currency. This brings us to the final question. When should you exit? If we're headed toward 100 or 170, at what price do you sell? Here's the framework that wealth preservation follows. You never sell for depreciating currency. Currency is a melting ice cube. You only exchange one asset for another when valuations shift. Right now, silver is undervalued relative to other hard assets. Eventually, at $100 or $200, it may become overvalued relative to alternatives. Watch the gold to silver ratio. Currently, it takes approximately 70 ounces of silver to equal 1 ounce of gold. Historically, that ratio averages between 40 and 50 to 1. In 1980, it briefly reached 17 to 1. If the ratio compresses to 30 to 1, that's your signal. You exchange your volatile silver position for stable gold. You effectively double your gold holdings without ever touching currency, or you exchange for income producing real assets. In 1980, you could purchase a median home in America for roughly 800 ounces of silver. Today, at 65, you need approximately 6,000 ounces to purchase a median home. Wait for that ratio to compress. When you can exchange a relatively small amount of silver for a down payment on productive land, that's the exit. Don't trade for numbers on a screen. Trade for acres. Trade for ounces of gold. Trade for cash flow. That's how you preserve the wealth transfer. We've covered substantial ground today. The breakout mechanics, the gamma-related buying, the institutional losses, the physical disconnect, and now the psychological framework. Wednesday, December 17, 2025. We'll look back on this date as the inflection point, the day institutional control weakened, the day the 65 barrier fell. The dynamic has changed. You can't reverse this process. The world now understands that silver is scarce. They understand the price was managed, and they're moving to secure positions. You're already positioned. You saw this developing when others were distracted. Now your job is straightforward. Don't move. Don't exit prematurely. Let the market come to you. The squeeze is just beginning. Hold your position.